Welcome to Moneycorp's Economic View for summer 2019. I'm Vicky Pryce, and I'll be taking you through the current economic developments and what we may be in for in the next few months. Well, first of all, of course, we are seeing right now that there are so many issues that any businesses has to look at, but making any decision about investing in the future. The environment is considerably more uncertain than it's been for quite some time. What we're seeing right now is a slowdown in the world economy because there are so many concerns relating to trade disputes, particularly between the US and China. In the UK itself, we have quite an uncertain political environment. People are talking now about possibly having an election in the autumn following the new Prime Minister Boris Johnson's election as leader of the Tory party. So there is a very uncertain path ahead. We are talking, of course, also about the possibility of a no-deal Brexit, which is very unsettling for businesses. And we've seen that, of course, affect sterling very significantly in the last few days. In Europe itself, we have quite an uncertain political environment. There have been a number of elections. In Greece, there's a new government. In Italy, the populist government is having difficulty with the European Commission in relation to its deficit and its debt. And there are negotiations going on right now with possible fines being imposed on it. In Spain, there's talk now possibly of another election. In Hungary, there are concerns about democracy. So it's not a very clear situation there. And of course, the European elections themselves a few months ago have worried some people because obviously there are still some extreme parties on the right and left which have done reasonably well. But overall, it doesn't seem to have been as bad as people feared. Nevertheless, it is one to watch. Bigger firms in this uncertain environment can cope considerably better. We've seen that actually also in the financial sector, which is worried very much about what Brexit might mean in the UK. What we had, in fact, very recently is the head of policy in the City of London saying that big firms have already done quite a lot. They've spent huge amounts of money. There are some estimates that has been in the billions preparing for Brexit, not just no deal. Smaller ones are less prepared. And there is no doubt that that is the case all across the UK anyway, not just in the financial sector. So Brexit prospects inevitably complicate the picture for anyone looking ahead. There are issues about whether one can still have the talent that's been coming from the EU in the future as well. What will happen to government finances? They are, after all, now saying they're going to be spending billions for no deal preparations. The question, of course, is will they be wasted if there is no deal? But let's go back to seeing what is happening internationally. The slowdown has been coming. The World Trade Organization has been looking at a number of indicators, such as international air freight, container port, throughput, and so on, to estimate the future. And what they did in late 2018 is begin to really seriously worry, because a number of those indicators, as you can see, have been going down. So indeed, they have been right. What's been going on is that both trade and investment have been on a downward trend, and trade and investment are very linked. What we have to bear in mind is that manufacturing companies generally are the ones that export more than others. Of course, there is service trade as well that takes place much more than used to be the case before, but those manufacturing companies or production companies generally, in order to remain competitive, have to invest. And what you see is that if there is a slowdown in trade, then investment also slows down. And that trend seems to be on a downward path, as the World Bank has indicated in a very recent report. So you can see that very clearly, of course, in relation to manufacturing data. If you look at what has happened in the last few months alone, you can see new export orders declining, and you can also see manufacturing globally slowing down very, very significantly. And anything below 50, of course, is a contraction, and that is something that needs to worry everyone, of course. With it, of course, global confidence falling too. So all these indicators are moving in the same way. One would have hoped that there would be, one perhaps indicator which is doing a little bit better, but certainly for the global economy, that isn't the case. If you look both on at the advanced countries and also at the emerging markets, that seems to have become a universal trend right now. Well, let's move to Europe, where, of course, so many of our exports go from the UK. What we have just seen is a dramatic decline in the business climate in Europe. Latest confidence indicators, which came out just a few days ago in very late July, very early August, show that confidence has sunk to the lowest level since 2012. When you look at particular countries, Germany itself has suffered from falls in industrial production and real loss of output because of the developments, particularly with the US, but also with China. So the slowdown has affected them considerably. And of course, remember, there have been tariffs imposed on some EU products too that go to the US, and we are in the middle of a trade dispute with the US right now. As a result, if you look at exports from Europe, Germany in particular, of course, depends hugely on exports to sustain its economy and act as a locomotive for growth for the rest of the Eurozone in particular. You see this very dramatic slowdown that has taken place. In fact, in particular months of 2019, you've seen a fall itself. And China is a very significant reason for this. What I've plotted here is not just the euro area, which is the blue line, but you see also that other countries have had similar difficulties because of the slowdown in China, which is affecting Asia more generally. And one very useful indicator is always to look at Japan, look at its exports to China, and you can see the decline taking place there as well. So the world is slowing down, China is slowing down. China is recording one of its slowest rates in decades right now, and of course the official figures always overestimate what is going on there. The underlying data suggests that perhaps they're growing at about 3%, which is very slow for China compared to what it did just a decade ago. So the Eurozone concerns as a result of that slowdown are also reflected in lending. What you see in this slide is what actually has been happening in Europe in terms of lending to firms. There was a period, of course, after the financial crisis when lending, in fact, was falling, and the economy, of course, was in recession, and we had deflation for a bit in Europe. And the European Central Bank had to step in very significantly to do everything it could, as Draghi, who is still now the head of the European Central Bank, said in a famous speech in 2012. It intervened by lowering eventually interest rates to negative for some interest rates that it controls, and putting huge amounts of liquidity in the market. And it's only through that lending has recovered. But as you can see in this slide, it's really not doing fantastically well in terms of really providing the type of funding that firms need. And that's a concern. And what is happening right now is that the European Central Bank is promising to do a lot more and start re-injecting funds into the economy, subsidized lending, possibly more quantitative easing, maybe looking again at its interest rates. So the environment has changed very significantly. And of course, the economic underlining, if you like, of what is happening in Europe is one that worries everyone. What has been going on, particularly since the crisis, is that a number of countries suffered more from the financial crisis than others. And what this chart plots is the inequality that has developed, the lack of convergence, which was what the euro was meant to bring about. This plots the change in per capita GDP of a number of countries in relation to Germany. So Germany is at 100, and you can see where it was at the beginning of the euro. The euro started being used as a sort of transaction, but a sort of bank transaction currency and an accounting currency since 1999. Notes and coins came into force in 2002. Things weren't going too badly at the beginning. A number of countries did quite well and catching up with Germany. And then, of course, the financial crisis came. There were no methods in the institutional framework and structure of the euro at the time to help the poorer countries except by lending them money, which they did reluctantly. But that, of course, pushed debt to amazingly high levels for a number of them. GDP fell in many countries, in Greece by 25%, but many other countries, including Italy, have not returned to pre-financial crisis levels, and the difference between them and Germany has become very significant in terms of prosperity and well-being. Nevertheless, most Europeans still seem to think that Europe is a good idea, and in fact, particularly I think because of the threat of Brexit, they have all become more pro-EU, and support for the EU seems to be at record high levels. So we're not actually going to see the breakup of the EU that perhaps some people during the Brexit campaign thought would happen. Instead, they seem to have come closer together in this respect. But this is not to undermine at all the problems that there are right now in the world economy and in the EU in particular. So looking ahead, the IMF has revised its growth for this year to just 3.2%. Just a year ago, it probably was expecting it to be something like nearer 3.6, 3.7, 3.8%. So quite a dramatic slowdown in expectations. Everybody has followed. And of course, we had problems with the trade disputes escalating. We've just heard, of course, very recently that President Trump is imposing 10% tariffs on extra 300 billion of Chinese exports to the US. So that's a big deal and a worry for trade all around the world. And what we're seeing, of course, is the slowest growth in China for 27 years, which is happening despite the fact that huge amounts of extra money and stimulus is going into the economy. So there are worries worldwide, there are worries in Europe in particular. We are expecting things to improve perhaps in 2020, but of course economists tend to be very optimistic. If you miss a target in 1 year, you think, oh well, I got it wrong because the timing was wrong, but things will improve next year. But in reality, they very often don't. But at least we have the US, which is growing reasonably. We have some export recovery in Asia, although not to China, as I showed you before. And there have been in the EU a number of trade deals that have been more or less concluded, but of course they need to be ratified. We've had recently with Japan, South Korea, the Mercosur countries of Latin America and Mexico. So that's quite good news. However, we've just had news that European growth has slowed down again in the first quarter to just 0.2%. There's uncertainty, of course, because we're having a new parliament, new commission, new heads for both the Commission and the European Central Bank. And the result is, of course, that people are thinking again about where interest rates might go, and Brexit is complicating the issue, affecting the exchange rate very significantly. So interest rate expectations have changed very significantly in the last few months, and we saw just in the last day or so, last few days, a cut in US rates for the first time in ages. They had been going up since 2016, and now they are beginning to come down again because, of course, they're fearing about a slowdown more generally. Interest rate expectations have changed in the UK downwards, and they have changed in Europe downwards. So we are not talking about a confident economy out there. If you look at Brexit, of course, the impact will be significant in the UK, but it will also be quite significant in Europe. The yellow line is the output loss that the Europeans expect may happen if we move to a no-deal situation with WTO, World Trade Organization rules for trade, and the blue bar shows the employment impact. So in both cases, quite negative. Also with a free trade agreement, because remember, the free trade agreements generally do not cover services, which are a very substantial part of the economies of advanced nations, and certainly in the EU. Anything that resembles Norway, which is the EEA solution, which is possibly staying in the customs union and the single market. Norway is not in the customs union, but we probably would be if we went into that type of arrangement. That minimizes, of course, the losses. But the uncertainty is out there and quite significant, and particularly for some countries like Ireland, which fear no deal Brexit particularly, but you can see this also happening in the cases of the Netherlands, Denmark, and some other countries, and Germany too, of course, up to a point, because of course it exports quite a lot of its goods to us and relies on our supply chain for a number of its high-level manufacturing production itself. So in the UK, in the meantime, unemployment, of course, is a big winner. It's come down to basically back to record levels we had seen before. And you wonder, therefore, why do we need to worry? Well, we do need to worry because what has been happening is that investment has been in decline. Businesses have been very concerned about the future, not just because of the slowdown in the world economy, but particularly because of Brexit. Some sectors like the automotive particularly worried. So what has been going on is that businesses have hired people to meet whatever demand there is, not paying them very much. Productivity has gone down as a result. And unless the climate changes, then we need to worry about the types of jobs that people right now will be doing. We know that in many cases people have to do 2 or 3 jobs to keep going, and in reality we still haven't gone back to real wages where they were before the financial crisis. What is also going on, of course, is that not only have we lost a huge amount of productivity, but the inequalities in terms of not just prosperity, but also manufacturing and other activity are still there. Productivity varies hugely between regions, and in reality, it's only London and the Southeast which are above the UK average in terms of productivity growth, and that's something which will affect competitiveness in the future, particularly if we are left in an environment where we no longer have the support, if you like, or the availability of the huge market that we have in the EU right now. This inequality is also reflected in relation to wealth. Obviously, there's a lot of talk now with new politics of reducing those inequalities and doing something particularly with the Northern Powerhouse and those regions that have been left behind. The truth is that since the financial crisis, those inequalities have increased. What I'm showing here is just the combined wealth. Of course, to a considerable extent, that reflects house prices, but you can see that differences are huge between regions, and it will take a long time for that to change. Europe, if you just see the implications of leaving the EU, they are the closest of our partners. We do still sell 45% or thereabouts of goods and services to the EU, and losing some of that will be an issue. Of course, it doesn't mean that we will lose it. It all depends on what type of environment we have in terms of trade ahead. That will take, of course, a few years to negotiate anyway. Many sectors are concerned about this. The automotive one, of course, I have already mentioned. Financial services, quite significantly impacted. But there is general agreement that both free trade agreements and World Trade Organization arrangements will impact, in general, negatively for most sectors of the economy. And the Bank of England has recently been talking about areas that will suffer, including chemicals and pharmaceuticals and other areas like that will be impacted by rules which are not as easy and open as they are now. What the Office for Budget Responsibility has calculated is that a no-deal Brexit will lead to recession, certainly in 2020, a 2% fall in GDP at least, and a big hit to public finances. And again, any firm thinking of investing in the UK, foreign direct investment or any domestic one, will be watching that very carefully, because obviously if demand is reduced, that affects any planning that one may be putting in place. The regional impact will also be quite significant. What the government has done is look at the different scenarios that might exist in terms of what type of deal the UK might strike. What you see at the very, very bottom with a little triangle is the impact on different regions in terms of loss of GDP, or GVA as we call it, which is the gross value added, of a WTO deal. So in all cases, it's negative, and in all cases, it's more negative than any other type of deal, and it is actually quite significant. So the worry is, given that I just spoke about inequalities, that a no-deal Brexit, certainly WTO, but any Brexit, will increase those inequalities rather than decrease them. And for London in particular, which is still going to be a very significant centre and probably will not do that badly, there are still serious concerns because, of course, so much is done in the UK. So many financial products are traded in the UK, and so many European firms decide to, in fact, raise money in the stock market in the UK through initial public offerings, that there is a joint wish to ensure that things move relatively benignly in the future. But in reality, if we become a third country, we no longer have the ability to sell our services across with the so-called passport, which allows us to do anything in terms of selling financial services across Europe. It's going to be probably a situation where we have equivalence, which means that at any point in the future, should the Europeans decide that our regulation is not equivalent to theirs, they can just withdraw the ability for us to trade with them. This is it. Thank you very much for listening, and I look forward to coming back with a new update in the future.